What if I told you that a government contractor just posted results that could signal massive opportunities ahead in federal markets and AI-driven services? Maximus just wrapped up fiscal 2025, and the numbers tell a compelling story about where government spending is heading next. Stick around because I'm counting down the top 10 takeaways from their latest earnings call, and number 1 might surprise you. Coming in at number 10, we have strong cash flow generation. Maximus delivered $366 million in free cash flow for fiscal 2025, but here's the kicker. They're guiding for $475 million in fiscal 2026, representing 30% year-over-year growth. That's serious cash generation capability that gives them flexibility for strategic moves. Their debt ratio dropped to just 1.5 times, putting them in excellent position for their next chapter. At number 9, the company is laser-focused on mergers and acquisitions in the defense sector. With $250 million still available for share buybacks and a comfortable debt position, management made it crystal clear they're hunting for acquisitions that unlock organic growth, particularly in defense and national security. They're targeting companies with customer relationships, technical capabilities, and business system certifications that can accelerate their entry into a market they estimate at $50 billion addressable opportunity. Number 8 brings us to SNAP payment error requirements. This is flying under the radar, but could be massive. Starting in federal fiscal year 2028, states with SNAP error rates above 6% will face significant federal funding cuts. The measurement period is already underway, creating immediate urgency for states to implement solutions. Maximus estimates they can address 90% of error causes through their AI-driven tools and decades of program expertise. At number 7, Medicaid work requirements are coming. The One Big Beautiful Bill Act mandates work requirements for the Medicaid expansion population of approximately 21 million people beginning in early 2027. States need to start planning now, and Maximus has 30 years of experience managing similar requirements for SNAP and TNF programs. They're positioning themselves as the conflict-free partner to help states navigate compliance. Number 6 showcases their AI ambitions with 30 deployments either planned or in process. They're not just talking about AI, they're implementing it across their enterprise. Their new Total Experience Management Platform, or TXM, is FedRAMP secure and AI-infused, designed to replace aging government contact center systems. Management described a recent demo as one of the most advanced AI integrations a customer had experienced. They're also serving as Customer Zero for their own AI deployments in IT service management and HR support. At number 5, the pipeline surged to $51.3 billion, up from $44.7 billion last quarter. What's particularly noteworthy is the composition. 64% represents new work, and 66% of the total pipeline sits in the U.S. Federal Services segment. The book-to-bill ratio improved dramatically to 1.0 times in Q4 from just 0.3 times in Q3, signaling accelerating pipeline conversion. Number 4 brings us an $86 million Air Force contract win. This Joint Cyber Command and Control Readiness contract marks Maximus's second major Air Force engagement and represents meaningful expansion into defense technology services. The company emphasized this win validates their strategy of pursuing defense and national security opportunities, with the contract including engineering analysis, software modification, and infrastructure maturation work. At number 3, margin expansion is exceeding targets. The company guided to a 13.7% adjusted EBITDA margin for fiscal 2026, which actually exceeds their stated target range of 10% to 13%. They're achieving this through technology deployment, automation, and disciplined cost management. Even with relatively flat revenue expectations, they're demonstrating operational leverage and efficiency gains. Number 2 reveals 12% organic growth in U.S. Federal Services. This segment delivered $3.07 billion in revenue, with all growth coming organically, driven by clinical work and natural disaster response. The operating margin expanded to 15.3% from 12.2% the prior year, showing that incremental volumes provide strong operating leverage in this business model. And the number one takeaway, adjusted earnings per share guidance of $8.10 represents 10% growth over fiscal 2025, reaching $8.10 per share despite essentially flat revenue expectations. This demonstrates the company's ability to expand margins through technology adoption and operational efficiency. The 3-year compound annual growth rate for adjusted EPS is an impressive 28%, reflecting both post-pandemic recovery and successful pursuit of higher-value work. Management is confidently positioning fiscal 2026 as a setup year for accelerated growth in fiscal 2027 and beyond, with significant opportunities in federal markets, state policy-driven initiatives, and AI deployment all converging at once. Leave your thoughts about Maximus in the comments below, and don't forget to subscribe for more earnings analysis from Earnings Central.